I think it's certainly feasible that this one could completely wipe you out if you are not prepared. And so that's what I want to talk about in today's video. I want to bring it back to pre-1998, pre the year that I was born, the year that I joined this wonderful earth, or at least the year that I was first aware in this current consciousness that I was on this earth. But I guess I wasn't really aware back then. Either way, I want to bring it back to I want to actually bring it back to the 60s. If you want to take it back, I want to bring it back to the years my parents were born. Okay, back in the 60s, believe it or not. I want to talk about in this video sentiment and investor psychology from a very broad perspective. This is not meant to be, prediction, doomsday, blah, 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 blah. It has nothing to do with that. Well, I guess it kind of does to a degree, but also it doesn't. This is meant to be, or to get you thinking about market psychology. And I have talked about this a couple times on live streams, but I want to kind of detail it a little bit deeper in more of a kind of concise format. And hopefully I keep it under like 10 minutes. I don't think it should be longer than that. Hopefully not. So back to pre-1998, back to pre-me. You could go back in time and see the market, right? And if you look at the S&P 500, day to day, it goes back and goes back. But I think what's notable is this period right in here. Okay. The reason why I bring it up is from the mid 60s to the early 80s. This is a period of time that was, let's call it 15 years, approximately 15 years where you didn't really make any money. If you were getting paid dividends, if you were investing in individual stocks that happened to go up, okay, yes, you could have been making money. You could have also been investing in stocks that went down and you could have lost money, or you could have just been investing in the S&P. And if you invested in the S&P 500, you would have kind of been pissed. I mean, like, if you currently, like, people in 2024 would look back at that and be like, no way, dude. Imagine 15 years. Like, people can't imagine going a year without a return on investment right now. Imagine going 15 years without much of a return at all. Now, if you were dollar cost averaging and buying the dip, you probably would have been coming out on the top, or came out great at the end of that, or the periods of time where, your portfolio was up and then it was down. It was kind of just oscillating around. But the point that I'm trying to get across here, though, is that was a span of 15 years. Okay. Now bring it back, or not bring it back, bring it through, I guess, the early 80s to 2000. So almost to when I was born, I guess. I was born, let's see, somewhere in here. I was born somewhere in here. And the market had a little bit more juice left in the tank before we ended up going through a bear market that was substantial, and then a period of about 10 years or so, or 9 years, that kind of sucked from an investing perspective. But what I want to bring your attention to is kind of this dip, right? Back in the 60s, or actually that was around the summer of the 70s, we dipped down. Market goes back up to a new high, then it dips down even lower. And if you go back and before that, there was actually a dip right here, back in the mid 60s, 66 or so. Okay. Then you have a period of time. There was one decent correction in there, but that was quickly bought back up, kind of like almost how COVID was to a degree. Maybe not as sharp of a buyback as that, but similar to that in our example. But then the market went crazy, or it just kind of grinded up, and then it had this, like, clearly a big extension. Now, you can go back in time and say, well, the Fed was doing this, and here was a state of monetary policy, and yada, yada, yada. And that's important. I joke. That's important stuff. Don't get me wrong. I'm not saying it's not important, but I'm more so concerned about the chart and the trend. That's really all I care about, and because it's not about predicting because you can get too deep into the weeds of it, and then you can say, well, because the Fed's doing this, then this should happen, and because the Fed said this, well, this should happen. And then when it doesn't happen right when you want it to happen, or when you think it should happen, then you get completely out of whack, and it's just, I think it's kind of irrelevant from a bigger picture investor psychology perspective. It really is. So great run, but that run very steep, right? Look at how steep the market was. It wasn't that steep prior to that. Not nearly as steep. Now it goes on a big run. Then we have bear market here for about a year and a half or so, from October 2000 kind of down to February of 03. So multiple years. Recovery, didn't get back to the highs, but just about did get back to the highs. And then bigger bear market, we went even lower and even faster back in 08, 09. Then the market starts to recover, and it's kind of just been grinding up since. And maybe you could start to make the argument that or I guess 2020 to 2021, very, very steep. And we could be on a pretty steep segment right now. Now, comparing that to this, these are pretty small. We might have more years to come, and we might. We very well might, and we might have much more of a rally to go. I don't care. I'm not saying that this is the top. If you know me, I don't do that shit. Okay, I don't care. It's irrelevant. Okay, let me get rid of all this shit. But we had a span of about 15 from the 80s, early 80s to about 2000. So let's call it between 15 and 20 years of very, very good run. Then we had about 9 years of correction. Prior to that, we had about 15 years of kind of a choppy market. You can call it bear markets. You can call it whatever you want to call it. We've now, right, since 2009, the lows that were established there, it's been about 15 years that we've been going up. And essentially what's been going on is, what I'm getting at is that dip buyers have been rewarded. Dip buyers from 1980 to from 1980 to through 1999 were rewarded, and then they weren't from essentially 2001 or 2000 through 2008. If you bought the dip in 2009, great, you've been rewarded. Ever since 2009 to now, every major dip has been bought back extremely fast when you look at this chart, because look at these. We're talking about multi-year bear markets. Right? Back in here, back in 2000, back in 08, 09, it was about a 2-year span, or a year and a half or so, whatever the time frame was. There was a couple year span back in the early 2000s. And if you go back to the 60s, there was multiple year spans there. And even bigger, it was a 15-year span of nothing, essentially, just chopping. So we haven't had that. I'm not saying that we have to have, in theory, we don't have to have that again, I guess. We haven't had that. And so what's happening is that from a market psychology perspective, you're able to have these periods because of the prior period in the cycle. You can allow dip buyers to be rewarded if a period prior to that did not. So you have this constant motion, this constant change. And so things don't always, if things always stay the same way, if dip buyers were rewarded so greatly, like they have been the past 15 years, call it, then it would just be as easy as any major dip, go all in on margin, triple down, take out a loan, and everyone would make money, and the market wouldn't operate. It's not how the market works. That would physically, if everyone was making money, that's not how the market works, right? So it doesn't work that way. And we are currently in a cycle right now where dip buyers have been rewarded. So what I'm getting at, and while I'm 8+ minutes in, what I'm getting at is there very well could be a cycle for multiple years where dip buyers are not rewarded, okay? And when dip buyers are not rewarded, after they had been rewarded for a while, you can set up the opportunity to lose a lot of money if you are not smart. As in, we get a major market dip or correction, it does not necessarily mean go all in, sell the house, put everything in. Because what if we have a 08 or 09 and we drop 30, 40, 50+%? What if we have a 60s into the 70s period where we have a drop, bounce back, drop lower, bounce back, drop even lower? So a simple dollar cost average approach, which stands the test of time, you can go back in time. It's simple as that. You don't have to think about it. A dollar cost average on the S&P approach is the easiest and most simple way to go about it. However, when we get a big correction and we dip and people start saying, oh, it's a dip buy, get in, and we get a little bit of a bounce, do not be surprised if we get a bigger dip lower. And that may go on for a longer period of time than we all could think. Just as the market going up, no one thought a year and a half ago we'd be where we are. Go back a year and a half ago, go back to the end of 2022. Nobody was predicting the market to be at 54.72 right now. The S&P, 54.72. The S&P at that time was at 37 something and change. Here we are at 54.72. Psychology. if you understand it from that perspective, that we will not continuously reward dip buyers, and the market historically does not continuously reward dip buyers, you'll be in a much better position to capitalize. Whereas we get the next dip and it's just same old. It's the same thing. Oh, market's pulling back. Yeah, it probably will and could, and who knows how low it goes, but I will keep doing the same exact things that I've been doing. I'm not going to get overly aggressive. I'm not going to do anything out of the ordinary. I'm just going to be buying the dip. Market goes up. Awesome. I'm going to keep dollar cost averaging as I should. Or if I want to diversify and take money out of the stock market to pay off my house, to pay off my debt, it's not a bad time to do so because the market's at all-time highs. If we think in that approach, instead of FOMOing in and immediately buying the dip because everyone says buy the dip whenever that happens next, you'll have a much more level-headed approach. And I believe that will serve you very, very well in the future. I don't know when it's going to happen. I don't care when it's going to happen. I really don't. Well, I guess I kind of do, but it doesn't matter. It doesn't matter. Just when we get the next cycle that starts to reward, or I guess not reward, dip buyers, do not be surprised and do not get caught up in spinning your wheels for something that inevitably will change, as in these cycles always do. There you guys have it. Thanks so much for watching. Hope it was helpful. Maybe it wasn't, but I'll see you in the next one. Peace.